Mutual Fund. Taher, great to have you with us here as always. Appreciate your time. Prashant this side.
Thank you.
What is playing on the market's mind, Taher? We've got a couple of days of very sharp cuts now.
I think we have, there's clearly a risk of sentiment which is prevailing, and we know the reasons. We basically did not really expect a very sharp turn from the Fed the way it has come about in the last few weeks. I think that was something which was probably expected to be a little more gradual than what it has turned out to be, both in terms of the unwind of the stimulus as well as in terms of the calendar on interest rates. And I think that is clearly something which has played out in the last some time in the global markets as well as in India. I think not all of it is probably, likely to pan out the way the Fed thinks. My sense is that probably the inflation rate at which it is today, both globally as well as probably a little bit in India, is likely to ease off in the coming months. I think we've also gone a little bit of shock on account of Omicron, so that's something which has also played out simultaneously. But there too, we have probably not seen things go materially awry in the last few weeks, and particularly the place where it all began from South Africa is probably starting to see some decline as well. So I think to that extent, maybe not all of it, the way the market thinks today is likely to pan out. Probably in the short term, it looks a little overdone.
Oh yeah, short term perhaps looks overdone, but tell you what, the Nifty is in danger of breaking 16,700. This morning we started with 16,891 as the first benchmark. That was gone, 16,800 was gone, and now 16,700 is also a distinct possibility. Remember, the 200-day moving average on the Nifty, for those who track technicals, we are at 16,708, is at 16,245 thereabout. Taher, good morning. The pocket which is holding out, by the way, it's 16,700, almost gone now. The pocket which is held out so far is IT. Do you think that could still remain the hiding space, or if the market, selling pressure accentuates, perhaps there also, we could see some profit taking?
This IT could probably be one. We will see the market turn defensive in several ways. I think, as I see it, in my mind, I think I'm probably at this stage, domestic stories in general. I mean, I think India is in a relatively better position, both economically as well as in terms of Omicron, compared to global markets. And to that extent, maybe it is better to play India stories. IT, of course, is relatively going to be more resilient because you will continue to see, once again, market getting excited about possible, more faster trends of digitization, etc. As one gets a little more nervous about the third wave of COVID. So that's something which will probably help IT stocks, apart from the fact that they've been continuously trending well in terms of their earnings trajectory. So I think domestic focused companies, probably within which, again, along with IT, even things like pharma, etc., might probably be a decent hiding spot. In general, probably large caps could probably do better than mid and small caps. So you are going to see some of those trends which generally accompany a risk-averse market or a risk-off market, as we've seen earlier as well.
Okay, it's risk off for sure. It's going and going fast. The Sensex is now down over 1,000 points and not stopping. 56,000 has been gone on the Sensex, given up. And on the Nifty, 17,000 has been given up with a lot of ease. It is looking scary. It's the first real signs of correction, right, Taher? I mean, we haven't really seen this market correct in over 1.5 years now. What is the most prudent advice in the sense, I mean, for the year 2022? Do you think equities as an asset class could take a bit of a backseat for a while? And if yes, any other avenues that you're looking at in terms of asset allocation? Or do you continue to buy this dip, in short intervals?
So in my mind, I think it is still a buy on dips market, and we are basically looking for an economic recovery which will probably strengthen during the course of the next couple of years as we exit, as we come out not just out of the downturn of the COVID, but even the meaningful downturn that the Indian economy has seen probably for 4 or 5 years prior to COVID as well. So in India, actually, two waves are currently unfolding. One is a larger wave, which is on account of whatever has transpired over the last 6-7 years, and within which there is a mini wave which is unfolding on account of the COVID disaster of the last couple of years. So I think, in our view, we still continue to stay pat on the assumption and the belief that the economy will strengthen, and I think you have to be tactical in the way you play it in 2022 versus 2021. 21 was different from 20, and 22 obviously will be different once again from 21. I think much has been made out of inflation. I think if the central bank's efforts around the world are to cool down on inflation, then I think that is what is probably going to start taking hold during the course of the next calendar year. And maybe in that context, it probably makes sense to look at companies which are going to be beneficiaries of cooling off of inflation. So I think it perhaps at some level might make sense to move from producers of commodities to consumers of commodities. That is where you might probably get, and especially in a correction where you also get better entry valuations.
Taher, seems like the market has pretty much given up that bet on large financials, your ICICI Bank and others basically, which there was so much hope built around post the very good second quarter results. What's your sense there with after what's happened to stocks?
So we clearly know, Sean, that in the last some time, what's dominating the narrative around banks is not as much of their own doing, but basically the whole story around fintechs and the fact that growth has been a little elusive. So I think market is reconciled to the fact that look, asset quality is not going to be as much of an issue as it has been in the prior some years. But where is the growth? But that is where I think the rub is, and we are seeing growth trends actually modestly improve. In fact, even credit growth, which was in the troughs of 5% odd, has kind of at least come back to about a level of 7% odd. Not necessarily very healthy, but I think at least the trend is looking up gradually. So I believe as we see more of credit growth in the system, and as we see the overall economic cycle start becoming a little more stronger, that should support banks and banking stocks. Meanwhile, there is of course the fear of fintechs invading some part of the business of banks, but our analysis suggests that there will be a sliver of profit streams and revenue streams which will be impacted, but then there is a large core of banks business which is an area which fintechs will find it difficult to step upon, and you can't still take away the liability franchise of banks which still overpowers and towers all the fintechs at this stage. So I think reality will set in. They are not necessarily at valuations which are very demanding, and therefore to that extent we still remain reasonably constructive on the financial space.
Okay, just pull out a latent view, by the way, 6% down on that. That's where the anchor lock-in opens today. So even a strong stock like that, we'll see some selling today in the first hour. Will be interesting to see if and when that stabilizes. But for starters, in line with what you normally see once anchor lock-in opens, the stock's down about 6%. Taher, some of these new age stocks, all these digital stocks and all, people have made a lot of money here. Or do you think that, and there will be a lot of IPOs in this space which will come over the next 6 to 12 months. Do you think that will be money making opportunity, or you think it's a bit overcrowded now?
It's overcrowded at some level in parts, but the thing is that this is a story which will still only strengthen as we go along. We all know what's going around our lives in terms of online and digital, and I think 2022 will probably be all about as far as online digital new age businesses is concerned, is their ability to continue maintaining their competitive advantages. Wherever we see that opportunity, or wherever we see that widening or continuing to build up, that's the place to be, and especially if you probably get entry valuations which perhaps are a little better than what we have seen in the recent past. But this is probably not a story which is going to die down meaningfully. I think in India we're just getting started, and there are a good number of decent quality businesses. There are some of which will also have a starting point of profitability, and that makes it relatively more comfortable.
Okay, well, this is not looking like a good screen at all. There's no recovery. In fact, the selling pressure continues. So, Taher, we'll have to leave it at that. Thanks a lot for joining us and giving us your view on the markets, which, by the way, is in complete profit-taking mode.